One of our viewers said they want to buy a home, but probably not for a year or two, and they asked what they can do now to start preparing for home ownership. Well, if you have any questions, feel free to comment on this video and we'll try and answer your question in a future video. Here are some things you can work on now, so when the time comes to buy a home, you'll be ready. Generally, you'll need a down payment to buy a home. While there are programs that allow you to buy with little or no money down, saving for a down payment makes the most sense because the terms of each loan type are different, and you'll be better off having more choices when it's time for you to buy. So how much should you save for a down payment? Well, if you can, try and save 20% of the purchase price as a down payment. Here's why. Mortgage insurance. Mortgage insurance is expensive, and it can add hundreds of dollars a month to your mortgage payment. None of the money you pay to mortgage insurance goes toward the principal of your loan or benefits you in any way. The purpose of mortgage insurance is to benefit the lender and helps them offset the added risk they take on when a borrower doesn't bring in a substantial down payment. So if you can save a 20% down payment, you'll be able to avoid mortgage insurance altogether. This significantly lowers your monthly payment and allows you to qualify for more home. Your payment goes down in two ways if you can put 20% down. First, you don't have to pay mortgage insurance, but also you're financing less money. To many people, saving 20% of the average home's purchase price may not be doable within a year or two. Buying with a lower down payment can still make sense if they plan to plant roots in the area for a while. If you can't save 20% of the purchase price as a down payment, shoot for 5 to 10%. The minimum amount required for most mainstream financing is 3%, but you will also have some additional expenses beyond the down payment, so 5% is a good place to shoot for. These other expenses are closing costs, and they include things like your loan fees, your appraisal, prepaid property taxes and homeowners insurance, title insurance, setting up an escrow account, etc. If your down payment is less than 20%, you will likely have mortgage insurance, either upfront, monthly, or both. My recommendation for a down payment is 5 to 10% minimum, while trying to get 20% or more if possible. The closer you get to that 20% amount, the less the monthly mortgage insurance cost will be. If you're a veteran, you can get a VA loan with zero down and no mortgage insurance. Just be aware that there is a funding fee that most vets pay up front that can start you off in a negative equity position. Depending on the amount a veteran has for a down payment, the funding fee, the interest rate, the mortgage insurance, and other variables, the VA loan often makes the most sense for a veteran, but not always, so they should have their lender run the numbers for both types of financing if a veteran has some down payment saved up. The same goes for other specialty loans like USDA loans. There are some opportunities for some buyers on some properties to get loans for zero down, but unless you know you will qualify and be able to find a property you can buy with that loan type, it's best to save whatever you can towards a down payment. Now 20% is that magic number where mortgage insurance goes away, and if you can get to that, that's fantastic. But there are some real frustrations and consequences some buyers could encounter if they don't consider their other options. In areas where home prices are rising, for example, some buyers can't save 20% fast enough to keep up with the increase in home prices. Waiting even longer to try and get 20% down could really set them behind versus buying with 10%, 5%, or even 3% down. Taking advantage of lower interest rates now could also offset the higher extra cost of mortgage insurance, especially if you have a conventional loan where you can drop mortgage insurance altogether once you have reached the 80% loan-to-value range. And you do that by making your normal payments that reduce your principal balance. Now, every market is different, and it would be worth consulting with a local agent to find out what's best for you. We can research and refer you to an agent in your area who can help start your journey toward home ownership. Just visit reprelocation.com to get started today.
For help finding a real estate professional in your area, visit reprelocation.com.